The stock market is a place where people buy and sell shares of companies. A share is a small part of a company. When you buy a share, you own a small piece of that company. If the company does well, your share becomes more valuable. And if the company does not do well, your share may lose value. People invest in the stock market to grow their money over time. Some want to make a profit quickly, while others keep their money in the market for many years. The idea is simple. You buy shares at a low price and sell them at a high price. The stock market has two main parts. One is the primary market, and the other is the secondary market. In the primary market, companies sell new shares to the public for the first time. This is called an initial public offering, or IPO. In the secondary market, people buy and sell shares that already exist. This is where most trading happens. Stocks are traded on stock exchanges. A stock exchange is like a big marketplace where buyers and sellers meet. Some popular stock exchanges are the New York Stock Exchange, the NASDAQ, and the London Stock Exchange. In each country, there are different stock. There are many people who take part in the stock market. Some are individual investors. These are normal people like you and me. Some are big investors like mutual funds, hedge funds, and banks. There are also traders who buy and sell shares quickly to make money from small changes in prices. Prices in the stock market go up and down every day. This is called market movement. Many things can affect stock prices, like news about the company, changes in the economy, interest rates, global events, and even the mood of the people who are investing. Some companies pay a part of their profit to their shareholders. This is called a dividend. When you hold shares of such a company, you may get regular payments from them. This could be another way to earn money besides selling your shares. To invest in the stock market, you need a broker. A broker is someone who helps you buy and sell shares. They may be a person or an online app. When you place an order through a broker, they send it to the stock exchange and the trade happens. There are different types of stocks. Some are called blue chip stocks. These are from big companies that have been around for a long time. They're usually safe and stable. Then there are growth stocks. These are from companies that are growing fast. They can give high returns, but also carry more risk. Then there are penny stocks. These are cheap stock from small companies. They can go up a lot, but can also fall fast and are very risky. You can make money in the stock market in two ways. One is capital gain, which means selling your shares for more than you paid. The other is dividends, which are payments from the company when it makes a profit. But remember, you can also lose money if the price of your shares falls. Investing in the stock market can be risky, but it can also help you grow your money faster than keeping it in a bank. That is why many people learn about the market before they invest. They read news, follow company reports, and use charts to study stock prices. Some people invest for the long term. They keep their shares for many years. This is called long-term investing. Others trade daily or weekly to make quick profits. This is called trading. Both methods have their own pros and cons. Many people follow a rule called do not put all your eggs in one basket. It means you should not invest all your money in one company or one sector. You should spread your money across different companies and industries. This is called diversification, and it helps reduce risk. The stock market is also a sign of the economy. When the market is doing well, it often means people believe the economy is strong. When the market is down, it may show that people are worried about the future. Governments also watch the stock market closely. They make rules to keep it fair and protect investors. For example, there are rules to stop cheating or using secret information to buy or sell shares. There are tools and apps that help people understand the market. You can see charts, news, and updates on your phone or computer. You can also use these tools to buy or sell shares. Many people also follow the market index. An index is a group of top companies in a market. It shows how the overall market is doing. For example, in the United States, there is the Dow Jones, the S&P 500, and the NASDAQ. In India, there is the Sensex and the Nifty 50. These indexes go up when most stocks go up, and they go down when most stocks go down. There are also other investments in the stock market like mutual funds and exchange-traded funds, or ETFs. These let you invest in a group of stocks at once. They are good for beginners because they give you diversification and are managed by experts. Before you invest, it is important to set a goal. Ask yourself why you want to invest. Maybe you want to save for retirement, buy a house, or grow your savings. Once you have a goal, you can choose the right stocks or funds that match your plan. You should also know your risk level. Some people are okay with ups and downs in prices. They're called risk takers. Others want to be safe. They're called risk averse. Knowing your risk level helps you choose the right type of stocks. Many investors follow strategies. One is buy and hold, which means you buy good stocks and keep them for a long time. Another is value investing, where you buy stocks that are cheap compared to their true worth. There is also growth investing, where you buy stocks of companies that are growing fast. You should also learn how to read financial reports. These reports show how much money a company makes, how much it spends, and how healthy it is. Understanding these reports helps you make better choices. It is also good to avoid some common mistakes. One mistake is following the crowd. Do not buy stock just because everyone is buying it. Another mistake is not doing your own research. Always study before you invest. Also, avoid checking prices every hour. It can make you nervous and lead to bad decisions. Remember, the stock market is not a place to get rich quick. It takes time, patience, and learning. If you stay calm and invest wisely, you can build wealth slowly over time. Some people also follow technical analysis. This means looking at stock charts and patterns to guess where the price will go. Others use fundamental analysis. This means studying the company, its business, and its value. Both methods can be useful.